Welcome back to the Business Workshop Podcast, where we bring all types of businesses and entrepreneurs into the shop to share their stories so we can all grow our individual businesses and help each other grow together. But first, I'm your host, Josh Handler, co-founder of the Handler Zimmerman team at Keller Williams Realty Elite. If you have a home you're looking to sell, reach out to us to help answer any questions or concerns about the process or just curious what your home may be worth today. If you're looking to buy, our team is here for all your needs. Give us a call, 516-732-6398. Now, in the workshop today, we have none other than Brittany DeGennaro, but should I call her Russell? I don't even know what to call you anymore.
Say DeGennaro-Russell.
So we're going to call you BDR.
That works.
She's from Roundpoint Mortgage, formerly, which was Freedom Mortgage.
Freedom Mortgage, yep.
So we're going to talk shop today about different programs that a lot of realtors don't know exist and are kind of new to the game of where a lot of even sellers never even heard of these loans, so they may get deterred if they're not
familiar with them, right?
Yep. So what we're talking about today is different grants and Sony May programs, which not every bank offers.
Yes.
And Brittany actually helped me buy my first house, which is how we met 5 years ago now.
Yeah, a long time ago. I think I was pregnant with the first one when I did your mortgage.
I think you were. Yes, you were.
Yep.
Well, now you're pregnant with number 2. So honestly, you were fantastic to work with in the beginning.
Thank you.
In the beginning. The whole time.
Yeah, thanks. Way to cut me short.
But a lot of people don't really understand, like, when we refer, like, a loan officer in the first place, how beneficial it is, why we recommend these people, because we've used them hundreds of times, because we know, like, they're able to get a hold of, and just the process. People think they're always looking out just for the rate or just for this. Like, even if it's a slight tick higher on one person to the next, it's just like you're paying for what you pay for what you get at the same time.
Yeah.
So, like,
Definitely.
having somebody that you recommend and actually work with is a huge advantage.
Especially in this market, like we were talking about before, if you delay even 24 hours with your client's pre-approval or getting their information to the listing agent, you're going to lose a house. So did you pay an eighth higher in your rate? Maybe for a certain program or so. Yeah, but you know what? You got the house that you wanted, you know?
So we'll stay on that topic for a second. Yeah. So what have you guys seen on the mortgage side of the competition? Obviously, everybody knows it's crazy out there. There's pre-approvals up the wazoo. People are out. You know, there's hundreds of buyers looking. No inventory for them to get accepted.
Yeah.
You know, what are you seeing? You know, you have a pipeline of a bazillion pre-approvals out there, and just, you know, they're just trickling in once they get accepted. Like,
it's tough for buyers right now because we have clients that we started with a pre-approval a few months ago before the market, you know, shifted tremendously.
Right.
And, you know, 2 weeks ago or a week ago, we lost 50 basis points in a day. You know what I mean? That's huge. So you have these clients that are on the cusp of qualifying, and then, you know, a week later, they don't qualify for that price anymore, and inventory is low as it is. So now they're kind of pigeonholed because they have to cut down how much they qualified for.
Right.
So it's been really tough for our buyers because we had people that started out low 3s, maybe even high 2s, you know, end of pandemic area or whatever. Right. And now they're looking at a 4.5% to 5% interest rate, which is a big difference. Yeah. So you had people that were paying above and beyond for these houses that, you know, the inflation was crazy with prices of homes. You saw it firsthand. And now these people can't afford those homes because their rates are so much higher. So your buyer pool is so much more limited too.
So if you were at, say, 3.5 and now you're at 4.5, so it went up a full point.
Yeah.
That's $60 every $100,000 that you were spending.
It's roughly a lot of money. And think about it.
So you're spending $500,000, you're talking $320 a month that you now either have to make sure you qualify for, but like that, you're now paying $300 a month more.
Yeah.
And if you can't qualify for it, you have to pay points to buy down the rate to get you back into there. You may have to pay points just to qualify.
And it's fine to pay points because a lot of people don't know this too, that whatever you pay in your prepaid interest, it really is just prepaid interest that you're paying to buy down the rate. It's a tax write-off. So it's okay. It's not like you're losing that money and never getting something back on it.
So if you're in the 30% tax bracket, you're paying
it happens.
2/3.
You get something back from it, you know, when you claim your mortgage interest. But at the end of the day, you know, a full percentage in an interest rate, that's a big difference in not only monthly payment, but debt to income ratio. So that's a huge shift, which is where the first-time homebuyer programs really are coming in handy too, because those rates are not priced the same way as regular rates.
Right.
So that's been really beneficial for first-time homebuyers. And if to be a first-time homebuyer, you just haven't owned a home in 3 years. Doesn't mean you've never owned a home in your life. So that's a big thing too for people to know.
I think the biggest thing is just the rate, and we're telling all our clients now, make sure like they're talking to the loan officer again, because what you qualified for a month ago,
it's not the same.
It's not the same.
Nope.
And listen, maybe your debt to income was on the lower side and you still qualify, but you're just going to be, your monthly number is going to be higher.
Yep.
But a lot of people in the first time home buyer realm, you were probably looking at towards the top of your budget. Your debt to, DTI was probably on the brink of being maxed.
Yep.
Most people. So now it's like, oh shit, I either have to buy down the rate. Do I have the money to do so I can qualify for the same thing?
Or
and if I don't,
cheaper.
you have to find something cheaper. But a lot of people were not calling their loan officer and finding out. And they're finding out after they get an accepted offer. And it's so hard to get an accepted offer now. So think about getting an accepted offer. And now before you go to contract, calling up your loan officer, hey, I just want to get like an idea of monthly payment. And they tell you it's another $300, $400 than what you were expecting.
It's a lot.
Or they say, you actually don't qualify for that anymore. We have to spend another $12,000 to buy down the rate so you can qualify. And maybe they don't have that money.
Yeah.
So it's like.
It's a big difference. It's a big difference from where they started. And that was, I posted a few weeks ago when the rate for Sony Mae was still in the 3s. Other rates were well into the 4s at that point. Right now, the Sony Mae rate, which I say Sony Mae, it's the first time home buyer program through the state of New York. Their rate starts at 4.25%, which compared to other interest rates right now, that's low.
So those are backed by the government?
State of New York. So the state of New York gives out a grant to help out with, they call it down payment assistance, but essentially it's closing cost assistance because it's coming off the bottom line at the closing table.
Okay.
So, that's just one benefit of the program because, somebody might not have the extra money to come out of pocket, but they get this grant that's going to take care of most of their closing costs. So that helps them with their down payment and everything else.
So speaking of that grant, we'll stay on that grant first.
Yeah.
So a lot of people are using that for closing costs, et cetera, right?
Yep.
So what are the necessary steps? Like, can that be done with any program, or is it only certain?
It's the Sony Mae program specifically, but you can combine the Sony Mae grant with other grant programs.
Okay, so you can layer the grants on top.
Exactly. Like Long Island Housing Partnership offers some great grant programs. I do a lot of loans for Northwell employees, and when they come to me, they don't realize that Northwell will give you a grant on top of the Sony Mae grant.
Like working at the hospital.
Yeah. So you could be eligible for funds through there. So I've had some nurses come to me that really only need 1% of their own funds and they buy a house. That's huge because as well as I do too, when you move into a house,
it's expensive as hell.
It's just a money bucket. So you just have to keep throwing money at everything that breaks or what you need to do and everything. So it saves a tremendous amount of money. And then also with the Sony Mae down payment assistance, they offer what's called the Neighborhood Revitalization Program.
I remember this one.
Yeah, so this is a grant for renovations, which is huge right now because you see people aren't buying the house for the house, they're buying the house for the area.
Right.
They're not buying their dream home. They're moving in and they're saying, all right, well, it's going to take some work, but it'll do one day. So if you could get 3% of the purchase price to take care of your closing costs, and then you could get $20,000 to help out with renovations on a home, it's a lot huge amount of money that you're saving.
100%.
And then on top of it, if you exceed the $20,000, you can roll in other renovation costs. So it's a renovation loan with grants, which is great.
So that's not 203K. It's totally separate.
Nope. 203K is an FHA renovation program. So this is a Sony Mae is a conventional mortgage.
Okay.
It's just different in a few different aspects because it's geared towards first-time home buyers as an incentive.
Can you still get one of these programs if you have like bad credit, or there's like tiers so that you still have to be?
I'm glad you brought that up actually because there's no minimum credit score. Now, you can't come to me with a bunch of missed payments and it's not, But I actually had a client just recently, and this has happened to me a few times. He was buying a condo, and his credit score was about a 610. Okay. Which is low.
Yeah, it's low.
Right. He didn't have anything that was too crazy in the last 2 years or so that was really damaging as far as missed payments, anything like that. The condo that he was going for, we could not get it to go conventional. Would not work conventional. Would not work FHA. It just wouldn't work. So he went to a different lender because he was shopping around.
Right.
A few months into the process, they turned around and said, "We can't approve you. You're denied. You're."
What was he getting denied for?
Because they couldn't get it to approve conventional.
So
I don't know what they did where they didn't run their findings up front to make sure it worked. Whatever the case was, 3 months down the line, now this guy's in contract and he realizes he can't buy this condo. So they come back to me. I submitted it to see if Sony Mae would approve the condo. They ended up approving it. So now not only is he closing, I'm actually waiting on one document from him. He's closing, but he's getting a grant to pay for his closing costs too. Yeah. So it was a loophole to get this condo.
To get it to work.
Because it wasn't FHA approved and it wasn't Fannie and Freddie approved. Sony Mae approved it. So he would have lost that condo if he didn't go with the
if he didn't get this grant, basically.
Yeah, and his rate's, I think, 4.25%, which, again, great rate for right now.
Now, is there any like PMI on there that like doesn't come off like almost like an FHA loan?
There's mortgage insurance that comes along with Sony Mae, which some people will use the down payment assistance to buy out the mortgage insurance because you can do that.
Gotcha.
So say you're getting $15,000 worth of grant funds and your upfront mortgage insurance is $10,000.
Right.
You could use the $10,000 to buy out your mortgage insurance and then the additional $5,000 towards your closing costs.
Gotcha.
So you can split it up a little bit that way too.
Okay.
But a really good thing with this program is that it's different in the sense of how it's priced for mortgage insurance and for interest rates. So with regular interest rates, there's something called LLPAs, so loan level price adjustments, right? Mm-hmm. So when you go to price out, let's say a conventional mortgage, they're going to take into account your credit score, the type of property, if it's a single family or a condo co-op, if it's an owner occupied or an investment or a second home. All of those things come into play when it comes to pricing out a loan. When it comes to Sony Mae, you don't have loan level price adjustments, so you get that rate if you're in that income bracket.
Okay.
So as long as it's a primary, you're a first-time home buyer, you're getting that rate regardless if your score is a 610 or an 800, which is huge.
Yeah, it's crazy actually that you don't like you could have a great credit score and you're just using it to save some money and you still
So that's no benefit. That's a huge benefit because if you have somebody that doesn't qualify for conventional because right now their rate's a 5%, but they can go Sony Mae and they're in the income bracket and their rate's 4.25%. Right. Now you just saved a deal.
Yeah, that's crazy to really think of because a lot of people don't know about the grants in general, and a lot of times it's more. I don't know if it's scary is the right word, but like they're kind of like
unknown.
You know, they never dealt with it before. So if you get a buyer that's like, oh, I'm working, like we have a client on the team that's working with a buyer like this, and you know they're going on the contract I think today, and they had to have a second like another appraiser come out I think for one of the grants or something like that. So you have to have the original appraiser and for the bank and then somebody else, whatever. But he's like, you know, they never done this before, so they asked for me, oh, you know, do you know anything about it? I was like, I really can't even answer it because you work with them so, you know, there's not many people out there that take advantage of these loans. And I don't know if it's for the fact that they just don't know or they think, you know, maybe it's going to be harder to get accepted than it already is.
I think that's what it is.
Like, do you have to go out there and you're telling them, oh, I have these grants, or like it's all in the back end, like it really doesn't matter at all to the seller?
So when I do pre-approvals, I look at everything. I don't like to give out pre-approvals without reviewing credit, income, everything, because if I don't, I might be doing a disservice to your client because they could qualify for Sony Mae and they don't know because they didn't give me their documents. Right. So by the time I review everything, I get in there where if there's something that I think is going to be a red flag on a Sony Mae file, I'll tell you. Right. I'll tell the agent, I'll tell the client. Most of the time, there's no issues. It goes through. It's fine. Right. If there's something a little hairy with income or whatever, we can submit it for an exception up front through Sony Mae so they can review it and say, we're good with this, move forward. Okay. So, you know, there's very few that fall through the cracks once they're in. If you have somebody that does come to me and I just say to you flat out, like, this is never happening. It's not, even if it does happen, you're going to lose this client's referral sources and everything down the line because they're going to make their life living hell. Like, we'll go a separate route. Okay. But, you know, I'm very transparent with my delivery and everything. And I think that's where the hesitation comes with a lot of agents accepting these programs because they're not getting transparency when it comes to the loan officers because maybe the loan officers don't even know what they're doing. You know what I mean?
Well, that's what we were just talking about prior. You know, I'm not going to mention the bank, but she's like, yeah, well, I just dealt with this bank and they took forever. Like, we need to bump out the date. They don't know what they're doing. And now sometimes bumping out that date in the grand scheme of things, most of the time it's not a problem. But, you know, if maybe the attorney go back and now you have to worry about losing that deal that you just worked your ass off as the realtor to get them accepted, which is hard enough in this market. Yes. Now you're worried about, because they think this program takes longer that they don't want to go with us for an extra, 30 days. Yeah. It's like
they blame it on the program, and that's I've seen that pretty often. Whereas we know what we're doing. We know if you know what you're doing, we know what we're doing. Everyone from myself down to my assistant, down to my processors, my underwriters, everybody is Sony Mae trained. We're on the website. I'm on the website personally. We know what we're doing. Right. You know what I mean? So it's a different animal. So a 100%. Lender that doesn't know what they're doing, could it take longer? Definitely. Yeah. But if you go with someone that knows them, you're good.
Listen, I know a lot of banks that strictly just say, listen, we just don't do them. Yeah. And I'd rather them say we don't do them than try to say we do them when you have no idea. And that's when shit always hits the fan. So it's like, it's a bad look for everybody. Definitely. So you're better off just saying, I don't do them. You don't get that deal. Let them go to somebody that literally does them on the regular.
It's the same thing with like renovation loans. If you go to a company that doesn't know how to handle a renovation loan, it could be a nightmare.
Right.
From start to finish. It just could. We have a specific department that handles just the renovation portion. So we don't have an issue with renovation loans.
Right.
You know, you just have to know what you're working with when it comes to different programs.
Yeah. So speaking of different programs, what are the, how many programs on that Sony May style are there really? And are the main ones, for example? And then we'll go into like kind of what's the difference between them?
Yeah. So they have the 3% of the purchase price, which is called just the down payment assistance. They have the neighborhood revitalization, which is $20,000 towards renovation. They did have another form of grant for down payment that was up to $30,000. They stopped offering it for a little bit. Hopefully that'll be back soon because that's huge.
Yeah,
$30,000.
Nice one.
And then I do business with Long Island Housing Partnership, like I was saying, that you can combine the grants that they offer with this program with the Sony May. CDC Long Island is another really good one that they offer you. It's not a grant, it's a loan, you pay it back.
Okay.
But still, they have a grant, a loan that's 20% down payment. So if you have a client that qualifies, they could get 20% down payment in those funds, pay it back in a small portion monthly,
right? Where
it'll eventually be dissolved because they'll pay it back.
Does that get hit as debt on the front end?
It will, yeah.
Okay.
It'll be included in their proposed housing expense, but at the end of the day, then they don't have mortgage insurance too.
Oh, gotcha.
And they can use down payment assistance to buy out their closing costs, to pay for their closing costs. So they're coming to the table. You only need 1% of your own funds for Sony May. That's it.
And then you're good.
So you can have a concession, you can have another grant, you can combine it all.
And the sellers really don't have to know about anything, right? Because that's really just your back end money.
Once they're approved for the loan, they're approved for the loan. The grant goes with it. So they don't need to know. So, speaking of a seller's concession, somebody doesn't have the funds, but they qualify for this program. You're not worrying
you're not
the
worrying
property
about
appraises or getting accepted
offer. Or just
offer.
getting them to even accept something with with that contingency even in there.
Exactly. Yeah, that's huge.
In this market, no seller is
It's
really
tough.
accepting something with a concession. It's just
tough.
not happening.
I know.
So to be able to know, okay, I don't have to ask for a concession. I'm getting it on the back end, through one of the programs.
Yeah. It takes care of it.
Huge.
Yeah, exactly.
So I don't know if all the rules are the same across the board for them, but like what's the, how long does it take to get approved? Like, is it a process? Because I heard sometimes it could take months to get approved for some grants.
Depends on where you're going for.
Yeah,
if you're going to Long Island Housing Partnership, you have to be approved for the grant prior to going into contract. So whenever somebody comes to me, we go over numbers and I say to them, okay, well, like for instance, a Northwell employee, someone just came to me recently. She had a pre-approval from another bank. She's a nurse, Northwell. And I said, you'd be a perfect fit for Sony May. But I want you to explore that first because you could be missing out on, $5,000, $10,000, $15,000 extra to help you out. So she has to apply through Long Island Housing Partnership for that grant first, then come back to me.
And how long does something like that take?
It could take a month or two from them. You just have to stay on top of your paperwork. But if you get money at the end of it, why not?
Right.
As far as the Sony May one, that goes through me. So that's done.
Gotcha.
As soon
so
as
it's like a standard.
Exactly. It just goes with the loan process and that's it. Yep. CDC Long Island, you can apply for while you're in the process as well. So we've had it in the past where a client had a concession, property didn't appraise. Now we got to bridge the gap. Go to CDC, apply. They'll get that.
So they're able to work pretty quickly, I guess, where like you could have it in 45 days or so?
Yeah, they go hand in hand with the mortgage process. So that one's pretty quick. So they're pretty, it's pretty easy to get them as long as you know where to go.
Right.
Which is what the loan officer should be helping the client with, because if those funds are available, why not take advantage of them?
Yeah. So when people get these loans and they're getting these grants, right? So they're not loans. So they're getting these grants. So maybe it's $20,000 here, maybe it's $10,000 here. Mm-hmm. You use them for whatever you end up using them, closing costs, repairs, whatever.
Yep.
Are these loans that you have to pay back, or are these ones that are forgivable, or
so
what happens with
the
them?
Sony May and most of the Long Island Housing Partnership work the same way. The Sony May loan grant, when you get the grant from Sony May, it's a second lien on the property, interest free for 10 years. If you sell that property prior to the 10 years, it's prorated. So you don't owe the full amount back, you'll owe a certain amount.
And that was what, the 3%?
That was the 3% or the $30,000 or the renovation. Any of those grants, they're a second lien on the property for 10 years.
Okay, so you have to stay in the property 10 years, interest, and then it's an interest-free loan.
Yep, and then it
they're
falls
giving
off.
it to you basically.
Yep.
As long as you stay there for 10 years.
Yep.
Okay.
Because they just want to help first-time homebuyers, which right now they're having a hard time with first-time homebuyers. Yeah. So they just want to help them. It's an incentive for them to get into the house. You know what I mean? And then, like I said, after 10 years, it falls off.
What's the benefit for Sony May?
Tons.
Is there?
Tons, yeah. Along with the grants, the interest rate is lower. the.
They're making the money on the interest. That's where they're thinking they're going to make their money by doing these things.
Oh yeah, through the state. Yeah. I thought you meant for the client. I was like, there's a tremendous benefit.
The bank side is the state. Like, where's the money? Like, they're giving away all this money. Like, where's the upside?
Yeah.
I guess it's the money that they're
in the
gonna
housing
make
market.
on the housing market.
Yeah. Definitely.
All right, so they get there. So 10 years
falls off
free. What about, is that the same for like the renovate, like when they get like 20K?
Yeah, the grants through Sony May are the same. 10 years falls off.
That's pretty good, honestly.
Yep, unless you sell, obviously.
Right. So
but
if
it's
you sell
prorated then.
It's based on how long you had it for?
Yeah, so we had some Sony May clients during the pandemic where they had so much appreciation in their home and they wanted to sell and cash in. They didn't care that they had to pay back $6,000 or whatever. You know what I mean? You were making money anyway, so who cares?
You're not going to not sell because you're worried about the money.
Yeah, my own sister did it. She sold her condo and bought a new one because it was a few $1,000s she owed back, and her value was so much higher. It didn't matter. She was still making money off of it.
Gotcha. So
you know
speaking of that, so can you use this on co-ops, condos, residential houses? Like you could use it on all of it.
Yep. Which is huge.
Pretty interesting.
A lot of people think that you can't. You can. Co-ops, condos.
Is there anything that you can use it on? It's only single. Like, can you use it on like a multifamily, like a 2 to 3?
You can. There's different rules when it comes to 2 to 3 families. You can use them on 2 to 3 families. There's actually a chart I can share the link with you that shows you the different income, different price point, that they max out at. But another good point that goes with that too is that now if you go over 647, you enter into high balance territory. High balance. I don't know if you heard Fannie and Freddie put an additional adjustment in those loan level price adjustments we talked about before. So second homes, high balance.
It's brutal.
It's bad.
4 points.
It's bad.
4? That's insane.
4?
Yeah, 4-point overlay, second home.
It's not 4, it's 1.
Oh, I saw something. 4 points. Over
if you're high balance on second homes. So high balance, now here's the thing with high balance, if you go over 640, you can still qualify for Sony May.
Not high balance, I'm talking jumbo, because Florida, there's
Jumbo's
no high
different.
balance.
That's a whole nother animal. We're jumping all over.
Yeah, sorry. That's speaking of that, absolutely crazy.
Yeah.
That Florida, there's so much money there.
Yeah, you just moved your
we're trying to.
Team down there, right?
We're expanding down there.
Yeah.
And it's like, so we've been looking for a house. And so I'm basically looking at different, price points, but like I have to keep it under 647.
Yeah.
Because other than that, it goes straight to jumbo. There's no high balance. So it just gets disgusting.
The high balance, so this is a good workaround too with Sony May for high balance. If you can go into the 700s and still stay at the interest rate and not get that price adjustment because they have different rates than the regular.
Right.
So you could have a client that is going Sony May 4.25 and they're buying their loan amount's a $700,000 loan amount and they're still getting that 4.25 rate right now.
That's good.
Because they qualify. Now, is it harder? Obviously, because if you're buying a $700,000-$800,000 home, you got to have the income to work with, and there's income caps with Sony May, but there's a chance that it could work, and if there's a chance, why not explore it?
Yeah, speaking of the caps, so credit, you said doesn't matter for any of these programs.
There's no minimum, but credit history is important, so as long as you don't have anything
saying
numerical,
where you
there's
fall
no
on the
minimum.
Scale, but as long as you're not making late payments and stuff
Yeah, exactly.
What about income? That you have to fit a certain box of income?
There's a certain bracket. So it depends on which program. There's 2 programs. There's the Achieve the Dream, and then there is the low interest rate. So it starts at about 124 is the cap for the Achieve the Dream income limit. And then it goes up to, I think it's 188 now for the low interest rate. So there's a big range in there.
And that's for both people combined that are on the loan or for a single
anybody
person?
that lives in the house. It's a household income.
Okay.
But that could work for your benefit too, because if there's a married couple, but they have a baby, you're a 3-person household. So the income cap is higher.
Oh, so the more people that live in there, the cap goes higher?
Yeah, exactly.
But the max cap is 124 on that one?
Well, the one program, it's 124, and then it goes up a little bit for more people in the household. And then when it comes to, once you skip over that, it goes up to, I think it's 188 now for the low interest rate program. So there are certain income limits when it comes to it, and then debt to income ratio is something that they're a little bit more strict with.
What's their?
They're at a 45. So if you're a little bit above, it's not
that much lower. I mean,
it's conventional basically.
Right.
I mean, there are conventional files where you can go up 50. To 49% or so, but it's not every file, especially now. So 45. If it's a little higher, we could usually get an exception, but it's a case by case.
That's not bad. I thought you were going to say something like in the 30s or something.
No. Nope, 40, 45.
That's not really that bad to be able to get what you're getting.
Yeah, exactly. Yeah, and if you're using, say the person's a little over, but they'll use down payment assistance, that they'll buy out their mortgage insurance. There you go. Now you work. Yeah. So there's ways of making it work too.
So like when they come in and they apply for these loans, and the loan and the grants, I guess all together, you're doing that all one shot, unless it's like one of those separate ones, like the CDC one, like you were mentioning. So you're doing all these with their pre-approval, like you're getting them pretty much approved for these like at the same time. So it's not like a multi-step. They're not going through all these different hoops.
I look at everything as a whole. I ask the questions I need to ask. And then if I think that they are a good fit for the program, I'll give them a pre-approval. I always like to give them a pre-disclosure proposal, which breaks down their estimated closing cost, monthly payment, has the rate, has everything mapped out. Because then people know as they're looking at homes, all right, this is what it's going to cost me. You know what I mean? It gives them a better idea.
And once they're approved for that, it's the same turnaround time as like a standard mortgage?
Yeah. As long as there's no issues with any mortgage, as long as there's no title issues, appraisal issues, anything like that pop up along the way, it's just a regular mortgage. That's it. It's just another program.
I just don't understand why more people
don't know it.
Do they not know it? Do they not qualify?
They don't know it. It's the same reason why some agents will say, well, I'm not accepting an FHA offer.
Right.
Why not?
Yeah.
Especially right now, because rates are so high that you might have a credit score of 670, which that's not a terrible credit score.
Right, but if you look at conventional, it's
well,
disgusting.
You look at conventional, you're in the fives with your rate, whereas FHA is more manageable, and mortgage insurance for FHA is a flat percentage versus conventional that uses credit score to price it.
Right.
So like people might just be doing it because they want to keep their payment within means. You know what I mean? Like you can't always shoot every offer down based on a program. You just need to do your research.
I feel like a lot of people, like I have people. Oh, we're not taking anything less than 20% down. We're not taking.
Why not?
We're not taking FHA, conventional only. It's like,
why?
If their offer's the best offer on the table, and you're just not taking it because it's an FHA, because they're putting down less money, like if they're fully qualified,
and loophole, you could be having somebody that's putting 20% down at contract signing, but that's not their down payment. Their down payment's 5% or 3%. They're just putting more down at contract signing to show that they have more skin in the game.
Right.
But they're going to use those additional funds for closing costs.
Right.
So now the person that came to you with the 3 to 5% could have had a better offer.
Right.
But you're saying, 20%.
Yeah, people are saying, we're putting down, 20%. They'll put down half. They'll put down 10%, which could be, I don't know, maybe it's $50,000 sometimes a contract.
Yeah.
But they're not ever putting down that other 10% because they know they qualify for the 10% down.
It's also it's a common misconception that 20% down is needed for financing a lot, and a lot of realtors that aren't familiar with the business as much will tell their clients, you have to because you avoid MI or whatever it is. Who cares if you pay MI? Yeah. Like what?
If you're going to good credit, it's $100.
And if you go conventional financing, you can do 10 to 15% down and buy out your mortgage insurance for like a few thousand if your credit's good. If you really want to, but why?
Yeah, keep the money in your pocket. Go do it for something else.
Go fix your house up. You know what I mean?
100%. So speaking of fixing houses up, the market, do you see it shifting? And if you do see it shifting, do you feel like it's going to get any better this year for buyers that are out there like hunting with like every last drop of energy?
It's a good question. I think so here's the thing, because rates are going up, the price of houses is finally going to level out.
Do you think so?
I think it's going to level out. Not some people, there's going to be a crash. Everything's going to come crashing down. There's going to be no crash.
So do you think the offers that are going crazy over asking and houses are listed for $550 or selling for $620, do you think that's going to start cutting back?
Definitely. I think that the housing market is going to level out because the rates are higher, that the buyer pool is limited now. Like we were saying before, someone that qualified for a $500,000 home doesn't.
Right.
And someone that qualifies for a $300,000 home, where are you finding that? A lot of people don't know this, that if you vacate your primary and you buy another primary, we can use what's called a pity wash, which is principal, interest, tax, insurance, as proposed rental for that home you're vacating.
Rental, yeah.
So you can keep that, make money off of it, especially if you don't have a mortgage.
Right, if the numbers work.
Go somewhere else,
right.
Buy, and is your rate a little higher? Whatever, you get a tax write-off, and you didn't have one because you didn't have a mortgage on this one. You know what I mean? Like, it's give and take. So I think it's going to be a good reality check for sellers. So yes, does it suck for our buyers that their rate's going to be higher? Totally.
Right.
But when we say higher too, like, you're in the 4s, low 5s.
That's the crazy part, because like,
I think my first place that I bought was 5, and maybe even 5.5.
Yeah, I think we were in the 4s like 5 years ago.
Yeah.
So like, that's the crazy part. You hear 5, you hear 4.5. 4.5, like 3 years ago, before this all started. It's
a great rate.
That was a great rate. Like, I think I got maybe 4.25 or something like that. I was like, all right. I was
great.
Like, that sounds good to me.
And then
like,
the pandemic came and people were getting 2s. And it's like,
and now like you were getting 3s, and then you were getting 3.5s, and then you were getting like, the brink of 4s. And now you say something 4.5, and then you God forbid you say the 5 word. It's like, what do you mean? I thought they were like 3.5 last week. I'm
I
like,
know.
yeah, in 1 week it went up like 75 basis points.
It went up a lot. It's the reality. So it's a reality check for buyers and sellers at the same time, where they're going to kind of have to meet in the middle here and be like, all right.
How are you guys still seeing like appraisal issues where like, so a lot of the agents on our team, like they've been going out there, showing buyers all weekend, day in, day out, and they're saying it's like impossible right now. It's literally, they think now it's worse than it is now than it was,
It is really tough.
6 months, a year ago, in the middle of everything. They actually feel like it's worse now. There's less inventory, the rates are higher, so it's hurting some people. And they're like, it's impossible to get accepted offer. Like your buyer has to be like supreme.
It's really
tough.
And
they have to be offering like some ridiculous number. Some of them are waiving appraisals. Like
a lot of people are still trying to ride the appraisal contingency train where they want that waived and this and that.
And that's the only, like we just had one. Ron actually just got one where that was the only way they could get accepted. Like there was no.
I just think that's unfair for buyers. And
the agent literally came back to them because they came up in price. She's like, literally, it's not coming up in price. It's literally the seller's worried that it's not going to appraise. So like, you don't need to keep coming up money. Like we were looking for the original number. If you're willing to waive the appraisal, we'll take that.
Yeah.
Like that's what they're concerned with. It's almost like they don't even care about the more money because if it doesn't appraise without that, they know like it doesn't mean anything.
Yeah, I mean we've definitely seen a few more of the appraisals come in shorter. I have a lot of buyers that put caps in their contracts as well.
Putting like 10
I'll go
15
15 grand over, and then that's my max.
That. Yeah.
Which you know what? If somebody's
that's
buying their forever home,
full on a waiver.
Yeah, if you're buying your forever home and you got to pay $10,000 extra for it, and you plan on staying in this house for the rest, who cares?
Exactly.
You know what I mean? But with the appraisals, in regards to the appraisals, I look at them often, and if there is an issue with the value or something, I encourage the realtor, hey, if you find other comps or anything else to support the value to go higher, that's fine. But you also have to realize that I have to do a due diligence by the client as well, that if that house appraised for this and the seller or the listing agent thinks it should be $20,000 higher, why would I want the house to be inflated $20,000 higher and screw my buyer and make them pay more for a house when the market's going to level out anyway and make them lose? Like if it's justified, we'll go back to the appraisal management company with the comps and try and say, what can we do? These support the home, whatever. But if I see an appraisal and I think it's justified, I'll tell the realtor flat out. I looked at the appraisal. The comps are legit. Like this is, I do this day in and day out for 13 years. I know what I'm looking at. You know what I mean?
That's how long you've been doing it?
Yeah, I started as a loan officer assistant when I was 20. Be 33 tomorrow, so 13 years.
I forgot, I'm older than you by a little bit, but this was always one of the topics of conversation. just older. It's crazy. I don't know what to expect, but what I'm hearing is on the mortgage end at least is they're thinking it's good. There will be like another refi boom because everybody that's buying now that are going to be in the fives, like they're eventually going to come back down, just like the housing prices are going to come down, and then they're going to go back up like everything else does. Like, that they could see like in the next year, like. I don't know. I hear two sides. They think in the with this year, it could be 6% interest rates. And then I'm hearing other people saying
it's
going to go, it could hit, in that ballpark, and then it's going to come back down. It could be back into the 4s or something like that. But everybody now that's in the mid 5s, like you're going to refi for 1.5.
I don't think we're going to have a refi boom. I think there will be refis. We're seeing a lot more cash out refinances right now. Which I want to shake people and say, like, where were you like a few months ago?
You when they were like 2%?
Yeah, because that's a price adjustment too, cash out. So when we're seeing a lot more cash out.
Why?
Because people now have the values in their homes that they didn't have prior to the pandemic.
So they're just pulling out that money.
So they want to pull out that money. And then we had people that were panicking because they didn't know what was going to happen with their 401k. Or something. So, you know what? I'm sitting on this money. Let me cash out and take the low rate because it is still a low rate.
Yeah, because if they don't take it and then the rate and then the housing prices come down, they're going to lose it.
Yeah, cash out, take the value, do what you want with it, So I definitely have seen a good amount of cash out refinances coming in for the first quarter of the year so far. More so than in the past. I don't think there'll be a refi boom necessarily.
Not like when everybody was running to the banks for.
No, because we're not getting 2% back.
Like, what would it take for that to really come back again?
Another pandemic.
Literally, probably, right?
A pandemic, a war, which hopefully
it never happens.
Yeah, but that's what it would be. So I don't see there being another boom. But I mean, there's always going to be a refi business available. Right. People need the cash out or whatever. So. I
feel more and more people are doing like like a home equity line instead of like, because once you get your rate, like you said, like it's a hit for a cash out.
Yeah.
So like unless like you were planning to refi anyway.
Depends on the program, and it depends on if you want to have two separate liens too, or if some people with student loans or credit cards now where their interest rates are through the roof. You know what I mean? They want to consolidate. So instead of having an 8 to 10% credit card percentage, you could take a 5% rate.
Find me a 10% credit card. I need one of those.
Yeah, exactly. Yeah, no, so it makes sense in that sense where you want to take the value of your home and roll it into one payment instead of paying those interest rates. So
that makes sense.
Yeah.
A lot of people can cash out, consolidate their debt, pay whatever 5% interest compared to
whatever they are now.
18% on the credit cards and 24% whatever they whatever they
they're
get
crazy
you for.
And they'll just keep going up as the other rates go up. So who knows? You know,
it is crazy. But all right, so I just want to recap.
Yeah.
Since the major things are these grant programs that are they all fall into the Sony Mae bracket, right? Mm-hmm. So all these Sony Mae programs.
Well, not as the other ones can be just conventional financing. You don't need to do Sony Mae.
Okay.
But if you
like
can, why wouldn't you?
Like that,
right? If you can combine them, why wouldn't you? You know what I mean?
But the main Sony Mae grants are, the home revitalization. You said
neighborhood revitalization. Yeah.
If the down payment assistance. So these are all programs that are legit just a Sony Mae pre-approval, Sony Mae loan that you, as long as you qualify, you can pretty much use these funds.
Exactly. There's no separate process for Sony Mae. You don't have to go through a separate application, anything like that. You go through us. And like I said, my whole staff, down from my assistant down to my processors, my underwriters, we're all very well versed in this, Sony Mae program and know what we're doing.
And like you said, you can layer those on top. So literally you can get the home revitalization.
When it comes to the renovation grants, it's a little bit different with the layering. So that's a little bit more specific case by case we would have to go over. But when it comes to the down payment assistance of the 3% or the $30,000, you can layer them with the other ones. Yes.
Gotcha.
Yeah.
So I mean, for first-time home buyers, huge to be able to keep more money in your pocket.
Definitely.
Like you said, it's for 10 years and then it falls off. If you leave before, it's prorated. At least you didn't have to take that money out of your pocket when it got you into the house. Maybe you couldn't afford it in the beginning, and now you're good. So now you paid. It is what it is.
Yeah.
So for people that really want to learn more about it, or they're looking to buy a home, they're in the market right now. They're like, shit, I could save $20,000.
Yeah.
What's the best way for them to reach out to you, get a hold of you, kind of go in depth more if they qualify and it works for them?
Well, Josh has a bunch of folders now with all of my information and his information as well.
Feel free to stop on by, grab one.
But also, you can reach me on my cell phone number, 631-560-0658. Again, I'm Brittany DeGennaro from Roundpoint Mortgage. You can look me up on the Sony Mae website. I'm listed there. You can look me up as far as my reviews online. There's a bunch of them. So my cell phone's the best way to get me.
Gotcha. And as I've used her once before, it definitely is a great experience. I've seen plenty of loan officers out there that really make the whole experience miserable because they really don't know what they're doing.
Yeah.
So using somebody that know what they're doing definitely helps the situation. So I will back you on that.
I appreciate
it. It was a
great
experience.
Thank you.
And she doesn't just do the Sony Mae loans, guys. So if you are looking for a standard, conventional loan or an FHA loan, they do it all. Direct lender. So you're not dealing with, your loan being shopped around or anything of that nature, which I always prefer for me. But again, if you have any questions, reach out to her, give her a follow on Instagram.
Yes, just Britt Deege, BRITTDEGE. And then you can look me up on Facebook, my full name, Brittany DeGennaro, too.
All right, guys. So you go follow her. If you have any questions or you want to take advantage of some free money,
that's right.
Do so. Not enough people know about these, and I feel the more people that know about them and the more realtors that learn about it, sometimes that may help your seller get more money if they could use more money towards free money towards their down payment. They could use more money for the seller.
Definitely.
So definitely learn about them. Again, if you're looking to buy or sell a home, give us a call, 516-732-6398. And until next time, the workshop, we'll see you next time.